I'd like to call this to order the meeting of October 22nd, 2025 meeting of the Homeowners and Commercial Property Insurance Task Force. A quorum is present, and the quorum includes several members who are participating remotely: Senator Doms, Aaron Cocking, Jim Johnson, Jacqueline Di Medici Bruno, Adam Axfeng, and Anna Midgley are all participating online, in addition to those present here in the room. First order of business then is to approve the minutes of the previous meeting. So is there anyone who has read the minutes and prepared to move their approval? It's in the package. I have a motion to approve. Any discussion, corrections? If not, all those in favor say aye. Aye. Okay, we have meetings. So we only have one item of administrative business, and Michelle Urick from the Legislative Coordinating Committee is going to give us an update on where we are with proxy voting. Ms. Urick.
Good afternoon, Chair, members of the task force. My name is Michelle Urick. I'm the Executive Director of the Legislative Coordinating Commission, and I'm here to provide a bit of an overview about some of the administrative items that the task force has discussed. Included in your packets is a memo dated today from me, and I'll be speaking to the contents of that memo. One of the questions that had been raised when the task force was contemplating what previously was referred to as a charter, and we're suggesting that that the name of that be changed and modified to identify it as operating procedures for the task force, was whether or not members could designate an individual other than themselves to attend task force meetings and represent them, and also potentially vote on matters before the task force. We've consulted with nonpartisan counsel in the legislature, and they have indicated to us and shared with us some of what was indicated as you were having this conversation, that the enabling statute that created the task force identifies who the individuals are, who the members are, and who the appointing authorities are. So those are the individuals who are authorized to take formal action as task force members. It's not possible for an individual to identify someone other than the officially appointed member who would attend a meeting and act in an official capacity. So if there are any votes before the task force, it has to be the officially appointed member. In a circumstance where a member is unable to attend a meeting, there's always the opportunity for someone to attend on their behalf and track the activities of the task force. However, because that person is not the official member, they should not participate in an official capacity unless invited by the chair to testify before the task force. And I'm happy to answer any questions about that before I speak to the other item.
Yeah. Members, do you have any questions on the information that Ms. Urick has presented to us so far?
I do have a couple of questions. Tim Johnson here. First question would be, is if that member that's been appointed, some of us are in associations, the association is the member, does that mean that a member of that association could show up and vote then? That's my first question. Second question, if the answer to that is no, and we know we're not going to be able to get to a meeting where there's a vote, are we able to send along our vote in another fashion if we're unable to attend the meeting? Those are my two questions. Thank you.
Ms. Urick?
Mr. Chair and Member Johnson, thank you very much for both of those questions. The association is the appointing authority. The association is not the member. So the association was designated in the enabling legislation to appoint an individual to serve on the task force on their behalf. And so if you're a member on a behalf of an association, you are the officially appointed member, and the association would have to appoint someone else and say that you are no longer the appointed member. The other question that you raised, thank you very much for asking that, about whether or not you can send your vote at another time. Members are only allowed to vote when they're present at the meeting in which the the motion or item under consideration is being deliberated. You cannot vote ahead of time or after the meeting, and that is because of the open meeting law. So it raises a question about conversations and deliberation that might be occurring outside of the official meeting. You certainly could send in writing to the task force your position on a particular item that they are contemplating, so that the members of the task force are aware of your position.
Okay, thank you.
Okay. Other questions?
Mr. Chair,
Yes, who is this?
this is Aaron Cockey, Insurance Federation of Minnesota.
Yes.
Mr. Chair, I think if that's the direction that the direction we've gotten from nonpartisan counsel, I think at minimum, especially as we get towards the end of the task force's work and we get to the point where we're voting on what's going to be included and what those recommendations are, we probably need to send around a doodle poll to find out the availability of members instead of it kind of just having been laid down at the get-go of when these are, to make sure that everybody is going to be able to attend. I don't think that's probably feasible to do for all these meetings, but certainly as we get to the end and we're voting on what's going to be included, I think it's only fair, since this isn't a huge task force to start with, that all member views are recognized and they have an opportunity to be at the meetings where these votes are taking place.
Thank you, and I'll address that one. I agree with you, and I doubt that we'll actually be taking any votes until we get to those January meetings. So when we were organizing the committee, I worked very hard with Austin and with DeMarco to get our meetings out on the calendar as quickly as possible, because there are all kinds of these legislative coordinating commission meetings, task forces, and I wanted to kind of stake out ground for us early on so that others wouldn't be able to schedule over us, or we wouldn't run into to scheduling conflicts. But I think for the January meetings, we're far enough out that I do think that it makes sense to do exactly as you suggest, Mr. Cocking, is to put out a Google poll, at least for those last two meetings, to see if we can find alternative dates in January where the most members would be able to be present in person. So if there's a general consensus to do that, and I'm seeing nodding heads around the table here, we'll plan on going ahead and doing that, to do a doodle poll to see what dates in January the most members would be able to attend to cast their votes in person.
Thank you, Mr. Chair.
Mm-hmm. Okay, any other questions for Ms. Urich?
And Mr. Chair, if there's one other item that
Okay.
I could address. So I also wanted to address the document that the task force previously considered. At that time, it was referred to as a charter. As we were having conversations with nonpartisan counsel about the aspects of the charter that referred to the voting and so forth, we looked at the document and are suggesting that the task force consider that operational procedures and not necessarily take action to adopt it, but consider it guidelines under which the task force is planning to operate. You'll notice that much of the content is the same as what you saw before, but there have been adjustments made to it to reflect the parameters around voting and participation in the meetings. But we don't think that it's necessary for the task force to take formal action per se, but just to use it as a resource.
Mm-hmm. Yeah, I think the only issue that we really had under serious consideration was this proxy voting issue. The proposed operating procedures, as we'll refer to them henceforth, are in the package, and I think that otherwise I think we're probably okay. Are there any members who have other concerns other than the proxy voting issue with the operating procedures as drafted? I think we're okay then. So thank you very much. Okay, so we're going to get to the meat of the meeting today. So just generally here, from our first couple of meetings, we kind of identified the issues that we want to address. We kind of grouped them into themes. And so for the last, since the second meeting, Mr. Turman and I, others members of the group have been suggesting testifiers for us. And so for this meeting and the next meeting on the 12th, I think we're rounding up a very good list of people to testify to us on the issues that are before us. We've got quite a few people lined up already for the 12th. We'll send out a list of the tentative list for the 12th as well. There are still a couple of kind of subject areas that we're looking to fill. I know Mr. Cocking is still working on getting us a testifier from the National Insurance Institute, and we want to get someone who is an expert from the reinsurance industry as well. But this week and next week, or this meeting and next meeting, we're kind of going to be drinking from the fire hose in terms of getting the testimony we were looking for. As we're doing this, we're also collecting all kinds of good white papers, studies, and Mr. Turman has been posting them up to the website as well and organizing them by theme. So there's going to be a lot of homework assignments as well. So appreciate the engagement from this group and members' willingness to kind of dive right in. But we've got a lot of information to absorb between this meeting and the next meeting before. But I'm hoping to get to, we might still need to have one or two more testifiers after that. But the bulk of the testimony I want to get out of the way this meeting, the next meeting, so that after that we can kind of roll up our sleeves and really get into the discussion. Okay, so this week we've got, I think some of these presentations will be pretty short. The ones we've kind of backloaded are probably some of the meatier ones, but there were, some organizations that at one point or another in the legislative process had been listed as potential members and didn't make the cut. And we wanted to make sure that they all had a chance to be heard. So we've got a couple of those today. But I think all of these will be very interesting, as will the ones from the meetings on the 12th. So we're going to be learning a lot over the next 2 weeks or so. So for today, I think the first person on our list is Paul Egger from the Minnesota Realtors. Is Paul here today? I haven't actually noticed him. Oh, Paul, are you on? Is Paul online?
I am, Mr. Chair.
Okay, cool. Thank you.
Well, Mr. Chair, members of the task force, my name is Paul Egger, and I'm the Senior Vice President of Governmental Affairs for the Minnesota Realtors Association. Minnesota Realtors is a business trade association with a membership of over 21,000 real estate professionals statewide who work with both buyers and sellers of real property. Thank you very much for the opportunity to be with you today to share our perspective on the issue of homeowners and commercial property insurance. I also want to thank you for accommodating my schedule by allowing me to testify via Zoom. I would be there in person with you today, but I just had to step out of our board of directors meeting. So again, just thank you for this accommodation. Over the past couple of years, including just this morning, actually, we've been hearing from a growing number of our members about the challenge rising insurance costs, and in the case of homeowner associations and even commercial property, availability of insurance are having on current homeowners, potential home buyers, and commercial property owners. While limited supply of housing and mortgage rates tend to receive most of the attention when the topic of housing costs come up, the rising costs of insurance and property taxes are also significant contributors to the growing financial pressure on home ownership. Mr. Chair, you're familiar with the work of David Arbit, Minnesota Realtors Research Director, but he has put together some data that shows the extent to which homeowner budgets are being stretched. As of September, the monthly PITI, or principal, interest, taxes, and insurance payment on a median priced home in Minnesota was $2,642. In 2021, it was $1,622. That is more than a $1,000 increase in just 4 years, and insurance costs are contributing to that upward pressure on homeowner budgets. An example of that pressure can be seen by looking at the annual cost of insurance on a median price home, which is almost $1,200 higher than it was in just 2019. Buyers tend to be more concerned with the monthly payment than the overall purchase price, so the rising cost of insurance has a very real and direct impact on the housing market. Lack of access to insurance or inadequate coverage can also limit the financing available to buyers, particularly where a homeowner association master policy does not meet Fannie Mae or Freddie Mac guidelines. We understand that this is a complex problem, but we are hopeful the discussions you are having on this task force will result in policy options that can be considered by the legislature. Minnesota Realtors is ready to work with you on this important issue. Mr. Chair, I also want to quickly touch on a topic that was mentioned at a previous task force meeting. Reference was made to Minnesota's condominium construction defects law, reform of which received bipartisan support in the past, and in 2017, some modest reforms were enacted. Because condos and townhomes often represent some of the most affordable homeownership options on the market, it is important to evaluate existing liability and associated insurance costs and any other laws or regulations that may lead to developers choosing to build rental properties instead of property for ownership. Minnesota Realtors is one of several groups that supported the legislation enacted in 2017 that attempted to address this issue, and we would support continued efforts to improve this area of law to stimulate more condo production. Thank you again for the opportunity to testify today. We appreciate the charge this task force was created to address, and we look forward to partnering with you on viable solutions to address the cost and availability of insurance.
Okay, thank you, Mr. Egger. Do members have any questions? If not, thank you very much. Our next testifier is Keenan Raverty from the Minnesota Mortgage Association, and appears he is present in person today. Welcome.
Thank you, Chair Elkins and members of the task force. My name is Keenan Raverty. I chair the Government Affairs Committee for the Minnesota Mortgage Association, which is our professional trade association representing mortgage lending in Minnesota. Also connected as a member to the Mortgage Bankers Association in Washington, D.C. as a liaison to national and federal efforts as well. My personal experience is a 33-year career, all in Minnesota, in mortgage lending. My day job is as a consultant, and after just leaving my full-time job a few months ago, led mortgage production for the largest mortgage lender in the state of Minnesota. I'm going to keep my remarks fairly brief, but hoping to touch on a few things. One, just an overview of the intersection of mortgage and insurance, how it relates, some of the recent issues and pain points that you're well aware of, both for the industry and for consumers. I want to touch a bit on the work that's being done, and there is work being done outside of this task force. And then lastly, and maybe most importantly, some hope for our future. In the overview I'll be giving, I'm really touching only on residential, not commercial. So this would be single-family units, 1 to 4 units. It includes units that a real person, an individual, would finance and not an entity, and could include those that are covered by associations in PUDs or condos or townhomes, that sort of thing. As you're aware, when we do a mortgage loan, our industry uses the home as collateral. So as part of that analysis, using the home as collateral, we require that there be sufficient insurance on the property. Now, it's important to note for this task force that our minimum standards as a lender are just that. They're minimum standards. They're really just to protect our collateral. They don't extend to what would oftentimes be referred to as a full homeowners policy, which includes personal liability, personal property, things that we think are important for people to pursue, but our minimum standards don't cover. Some of the things that those industry standards do touch on are things like deductibles, and really what's the maximum amount of deductible someone could have, the coverage sufficiency, is it sufficient coverage for the purpose of the mortgage loan, and then lastly, what happens if there is a loss settlement. And probably of most interest across the country and in Minnesota would be roofs and other non-building structures when there is a claim. And this, of course, also extends to what we would consider HO6 policies and master policies when there are governing associations. think it's important for this committee to also recall relative to mortgage banking that insurance is required both at the time of origination, which would be either a purchase or a refinance, and then also throughout the life of the loan. So it's looked at in what we call loan servicing. Normally that is done at time of annual renewal or if there's some other event date throughout the policy. There's different reviews at origination and at servicing, but both can be pain points, of course, for consumers and the industry. And I'd say the most comprehensive review is normally done at the time of loan origination. For my entire career in mortgage lending, we've always required our industry replacement cost coverage for most of those loss claims and sufficient coverage tests that we go through, and that includes things like roofs. We think that that has served the industry well and the consumer well throughout that time. Most recently, that has been a pain point that we'll talk a bit more about later as well. But I do think that actual cash value, as you'll maybe talk about it, and is more popular for consumers to pursue as an option, is currently not acceptable to those market standards. In addition, if a lender is determined that coverage had lapsed at some point or a consumer was unable to obtain coverage, it would be the lender's responsibility to put force-placed coverage in place. That's painful for the lender and for the consumer, and it's typically been avoided at all costs because of that. Neither the consumer nor the lender wanted that. It typically was inferior insurance at a higher cost, and so as you can imagine, that was a relatively infrequent event over time. We're starting to see that more and more recently. When we talk about lending standards, as far as what are we referring to, and I'll be available to take questions if the chair deems that appropriate afterwards as well, but we're primarily talking about loans that are pooled and sold on a national scale. This is through the government-sponsored enterprises of Fannie Mae and Freddie Mac, which, and for the record, I don't know the exact percentages, but roughly about 70% of loans across our nation are held through, and those are what are called conventional mortgage loans. And also our government-backed mortgage loans, which again, for the record, not an exact number, but around 24-25% of the marketplace. So you can see the combination of those two as those loans are pooled represent, upwards of over 90% of all the loans, 95% of the loans that are done. That's where we look for those national standards relative to that insurance. But even though those are national standards, we tend to look at things as Minnesota. How does that affect Minnesotans, of course, and of course that's what this task force is looking at as well. But really, Minnesota is not alone in this issue when we talk about mortgage lending and some of the challenges that we face both as an industry and in helping our consumers. So really, the Minnesota Mortgage Association, along with many other trade groups nationally, are working cooperatively with the Mortgage Bankers Association to pursue significant reforms and allowances and really what I'll frame as solutions to some of the issues that we've been framing. Those solutions would provide consumers with more options, potentially beyond just typical replacement cost coverage, extended again to things like roofs and non-building structures. Potentially more flexibility with deductible. And this could also include some of the onerous per unit deductible maximums that are put on those that live within associations and are covered by master policies. And then lastly, some more comprehensive allowances for expanded HO6 policies, again, for those folks that live and are governed by some sort of association for that. And these reforms and solutions, as I'm framing them, would be both for loan originators, helping new loans be put in place, and loan servicers. You're going to get lots of testimony today from many folks that are going to talk about how this has been a challenge to Minnesota, so I'm going to not touch on that today because I think you'll hear from other groups, but we are finding that this is indeed a real issue that we're hoping to address. But now with, as I close, I want to just offer a bit of hope. I had even hoped that by the time I provided this testimony, we could talk about the announcement of some policy changes on a national spectrum. And again, this is Fannie Mae, Freddie Mac, the Federal Housing Finance Agency. As they look at that would allow for more of these flexibilities. That has not yet come. I'm hopeful that they will be announced in the coming weeks or months. And if not, at the end of this year, certainly early 2026. There's been a lot of meaningful work done that will give both lenders and consumers options there. And so I'm very hopeful about that. And I hope that this task force, before endeavoring to make any changes, just keeps in touch with our trade associations to monitor how that's evolving at a national level. And so with that, I'll give thanks to Chair Elkins and to the task force, and to, if it please, Chair Elkins, be available for any questions.
Members, Mr. Berkwitty?
Thanks for your testimony. I have a question follow-up to your mention of replacement cost insurance requirements for lenders. Do lenders in Minnesota typically accept coverage from the FAIR Plan or from a surplus carrier as an RCV product for issuing that loan?
Mr. Chair, I humbly admit I don't know the answer to that question.
Okay. I had a question. So what happens if in an annual review, an existing mortgage holder loses their insurance that is conformant and can't get another one? What happens to that person's mortgage?
Well, again, it's driven by the consumer, and so if they've lost their coverage because it's something that they don't feel adequate or they just can't find coverage, that would be different than if they just, but ultimately the result is the same, is that if they don't pursue adequate insurance, the lender is going to have to force place insurance at their expense. So they end up paying for that. But again, keep in mind that that coverage really protects the lender's interest from a collateral perspective and is really probably an inferior product.
Yeah. So basically, the responsibility falls to the mortgage holder to find insurance if the consumer themselves can't do it.
And the lender really works with them to help pursue options. It's important to note that we think that a lot more education is needed in this area for consumers to understand their policies, understand that. But we also know that our mortgage industry is very limited in that we're not licensed insurance agents. We're not able to counsel people. We can describe what the minimum standards are, but that we're unable to make recommendations. But yes, that forced place insurance would be the result. Chair Elkins.
Thank you. Ms. Johnson?
Thank you. Thank you for your testimony. Really helpful. And I am curious when you might have your solutions or recommendations that you could distribute out. And then also, could you give a quick summary of what forced-placed insurance actually is for everybody that's maybe newer to this field, including myself?
Yeah, thank you. Mr. Chair, to respond, I'll start with the second. Forced place coverage, I'll provide this committee or this task force a better definition. But essentially, the way that works in Minnesota is that the consumer is encouraged and actually required to pursue a coverage. The lender has some minimum standards that just protect the collateral itself, but really most consumers pursue other full policies that will protect things like personal liability. If I come over to your house and your dog bites me or what have you, or I fall down your steps, and then also for personal property. So if in the case of a loss that you're covered there as well. The lender's forced place insurance in most cases doesn't offer those extended protections to consumers. It's really just to protect the minimum requirements of the lender, which in most cases would either say that there has to be adequate coverage to rebuild the home in the case of a total loss, it burns down in a fire, blows away in a tornado, or to repay the mortgage. Now you can see how there could be a conflict there. If to rebuild the dwelling it's going to cost $400,000, but to pay off the mortgage there's only $200,000. The lender's forced place insurance could really be the lesser of those two, to just say as long as we can fulfill the mortgage responsibility but you can see how a consumer could be harmed there when that gap existed. So the forced place insurance is really considered a last resort. In many cases, it's not something that lenders or consumers should be pursuing. It's been sad to see many people throw up their hands recently and say, I guess you're just gonna have to force place insurance because I'm exhausted by trying to find it in the private market.
Good question. Mhm. Did you have a follow-up?
Thank you so much. And I also was curious if you have any examples or information on more of the commercial property side, because something we're experiencing, I represent nonprofit affordable housing providers and single-family developers as well. And one thing we're seeing on the multifamily side is you kind of touched on this or mentioned it, the amount of coverage that's needed. For example, I just had a member email me last week saying, yep, had to go seek out 50 different quotes again, got one. And by adjusting the coverage because they're not taking claims, is that something that you're starting to think about in figuring out potential solutions or adjustments for required coverage on properties that, are covered or invested by certain mortgage bankers?
Yeah, Mr. Chair, for the scope of my discussion, I'm just really limited to residential properties, which is the work that I do through the Minnesota Mortgage Association and the solutions that we're seeking through the Mortgage Bankers Association of America and the reforms through Fannie and Freddie. There may be other efforts that are undergoing in the multifamily space. I'm just unaware of them.
That's something we're probably going to want to find somebody to testify about.
Yeah, Chair Elkins, if you have a colleague that would be maybe available at the next task force meeting, and that's okay, I would appreciate somebody to speak on that. Thanks.
Yeah, great idea. So we do have two people online, and then we'll come back to Mr. Reams as well. Senator Doms, you had a question.
I don't have a question, just a comment, and the
Yep.
presenter did touch on it, but on financial institution force-placed insurance does not include liability, and that is a big issue. Just want people to realize that.
Yep. Okay, thank you. Tim Johnson.
Thank you. I was just curious how the Mortgage Association views there's been a growing trend towards a hybrid style policy that starts out as replacement costs, but over time becomes an ACV policy, or there's a schedule which decreases the amount of replacement cost at each year that the material gets older. I'm wondering how the Mortgage Association views that, if you take any view on that.
Thank you, Mr. Chair. It's a great question, and I would say that I'm not at liberty to speak to the specifics of some of the solutions that I'm hopeful about, but I can let you know that that's certainly been a consideration as more and more insurers are offering that as an option to consumers that seems to be acceptable to consumers. Our industry wants to be open to understanding what that means, and so I'm hopeful that that, amongst other things, will be some of those additional options that are announced in the near future.
Okay, great, thank you. Mr. Reams.
Thank you, Mr. Chair, and thank you for your testimony. I know you're not representing Fannie and Freddie, but question if you could clarify, for HOAs, CICs, is there a cap Fannie and Freddie have on the wind hail deductible that they require to be under 5%, 10%? Is there a requirement on that?
Right, Mr. Chair, yes, it is my understanding that there are requirements there, and they're fairly antiquated, meaning that they haven't been updated or modernized in some time, and that can be problematic as associations have pursued to renew coverages and found that they have to have, for example, larger deductibles or other considerations. That indeed is a consideration. So that would cover the residential work that I do for an individual that would buy in an association-governed single-family unit in a townhome, condo, that sort of thing. And so, yes, and that's another area where education is needed, as it's been pointed out in previous committee meetings, that indeed the folks that run these volunteer boards and otherwise may not be aware of all of those secondary market requirements and might be making changes to their policies that are impact even ability of homeowner units to resell. So, but to that end, I'm hopeful that there will be forthcoming solutions that would allow more flexibility in that space, both to the master policy, how that's looked at and is reviewed by a mortgage lender. I think that was your question. Yes, we review the master policy, and then we also will review the HO6 coverage that would supplement and work in coordination with that.
Great, thank you.
Thank you.
I don't see any other hands, but Mr. Rabber, I would just say this has been very valuable testimony. I want to thank you very much for appearing before the group. This was actually much more informative than I expected it to be, so thank you very much for coming.
Thanks for having me.
Our next testifier is Teresa Ruiz from the Minnesota Homeownership Center. Okay, welcome, Ms. Ruiz.
Hi, my name is Teresa Ruiz. Chair Elkins and members of the task force, I am here today to testify on behalf of the Minnesota Homeownership Center as a representative of the network of homeownership advisors in my capacity as a homeownership program manager at a Minneapolis-based organization called PRG. I am also a licensed insurance educator. Through my work with families working to achieve homeownership for themselves, my colleagues and I are seeing growing challenges with insurance affordability and access. A major issue I see is how insurance is being handled during the mortgage approval process. Premiums often need to be as low as possible in order to keep the mortgage approvable. High deductibles are the go-to norm in these cases, and buyers don't always fully appreciate the ramifications until they need to file a claim. On top of this, premiums themselves have skyrocketed. Many families are now seeing sudden jumps into the $8,000 range per year. Several carriers have already pulled out of Hennepin and Ramsey counties, and insurance companies are refusing to provide coverage for homes older than 20 years or with roofs older than 20 years, regardless of the condition. Even if existing policies are in place, we are seeing renewals contingent on replacing roofs based on age when in-person inspections find no issues. All of this is leaving middle-class families, especially those in inner city and suburban communities, with very few and very costly options. This environment is unsustainable for working families and first-generation homebuyers who are trying to achieve stability through homeownership. Without intervention, we risk further eroding affordability and access to housing in our state. In preparation for my testimony today, the Homeownership Center has gathered stories from other network members here in the Twin Cities. We have gathered information from Duluth and Detroit Lakes, and with that, I will share their testimony and challenges they are seeing. One story in particular stood out for me regarding a struggling homeowner facing possible foreclosure. A major contributing factor was a near doubling of her annual insurance premium, from around $1,350 per year to more than $2,400 per year. Such sudden increases are simply not workable for so many of our neighbors, as we all are navigating rising inflation on everything from groceries to healthcare premiums. In closing, I urge you to explore solutions that will stabilize the homeowners insurance market in our state. Families deserve transparent communication, reasonable premiums, and policies that truly protect their homes. Thank you.
Okay, thank you. Member questions? I have just one. If your organization or the affiliated organizations have compiled data about this issue that you can provide to us, we'll make it part of the required reading.
Okay.
Okay, thank you. If there are no other questions, thank you very much, Ms. Ruiz.
Thank you.
Okay. Our next presentation will be from the Minnesota Association for Justice, Joel Carlson and Jake Jagfeld.
introduce yourself.
Good afternoon,
Gentlemen.
everyone. I'm Jake Yaugfeld. Thank you, Chair, members. And I'm a member of MAJ as a private practice attorney and also at the moment chairing the legislative committee for the organization.
Okay.
Hello, Mr. Chair and members. My name's Joel Carlson. I own a legal research and government affairs business in St. Paul, and I'm here on behalf of the Minnesota Association for Justice, MAJ. I've represented MAJ for many years at the Capitol, and I've been through dozens of task force studies, proactive and defensive legislative fights on behalf of consumers, policy holders, and their attorneys during my legislative service. And I think it's fair to say I'm not going to be nominated for the Minnesota Insurance Hall of Fame. When the idea of studying liability and tort reform to reduce costs was added as an amendment on the Senate floor, I will admit that it increased my blood pressure, as these conversations have done in the past on many occasions. But our association, well, we find it odd that we're lobbying lobbyists who are sitting on the panel. We are going to take a more academic approach to the study that you're undertaking and not engage in a soundbite battle of tort reform increases costs, or that just doesn't really help us. So the starting point for us is to look at what the field, what the language says of the statute, right? Which liability claims and tort reform to reduce costs. And the only discussion on that was on the Senate floor. And so we're assuming that we're not talking about construction defects and other policy claims, storm-related claims in this segment of your study. And we're going to focus just on injury-related tort claims. And for us, where we started is just how many of these claims are there. According to the Minnesota Supreme Court, in 2024, there were 1,856 personal injury claims filed in Minnesota for all of our 5.7 million residents. And that number is down. They've been tracking these for years. When I started, there were about 6,000 claims. They're down 23% since 2018, when there were about 2,400 cases. And according to the National Center for State Courts, that represents about 1.5% of all filings in Minnesota courts. And that's pretty consistent across the country. And while the relatively small number of claims gives you an idea, we don't know how many of those may be made against a homeowner's insurance policy or a commercial insurance policy. And so to get to the bottom of that part of the equation, we went to the database at the National Insurance Information Institute. Not my favorite source of information, as it is an insurance carrier-driven association, but they have some data that I think is instructive. And according to III, in 2023, 97.3% of homeowner insurance losses were the result of property damage claims: wind, hail, fire, theft, water damage. Those were the overwhelming cost of losses to the insurance industry in 2023. Liability claims accounted for 2.1% of losses. 1.7% of that were for bodily injury claims. And according to the Institute, it's like about 5.6, 5.7% of homeowners will have an insurance property-related claim. 0.09% may see a liability claim filed against their policy. So 1 in about 36 homeowners might have a property claim. 1 in about 1,200 homeowners might see a liability claim. We're talking about a very small portion of the homeowner insurance premium. And I would suggest that based on that, eliminating liability coverage, which is a mandatory coverage and it's important, wouldn't really save that much money if you eliminated it altogether. Now, nobody would advocate for that, but when you talk about tort costs and reducing costs, that's the amount of money that you are looking at of the total homeowner premium. And So I just, as you look at this, I think we can demonstrate easily that tort claims are in decline and are not a significant amount of the homeowner's premium. But why are premiums going up and why are consumers unhappy? We know that the costs of storms, the severity and frequency of storms are all going up. The replacement costs due to inflation and supply chain are driving the increase in insurance premiums. In Minnesota, we have increased risk for weather and freezing that drive the cost of premiums, and insurance company performance all factor into the rising cost of insurance premiums. The Minnesota Department of Commerce and the Insurance Journal report that while premiums are going up, consumer complaints are going up as well. We've had 108% increase in complaints to the Department of Commerce on homeowner insurance claims and policies over the last 3 years. And so complaints are going up, costs are going up, and at the same time, while I appreciate that 2022 was an extremely bad year for the insurance industry, they had heavy losses in 2022. AM Best reports that since that time, profits have increased for insurance companies 333%. They made a profit in 2024 of $168 billion, and for the first time, property casualty premiums in Minnesota topped $1 trillion. So there are a lot of things that go into this. A small part of it is liability claims. And in Minnesota, the National Association of Insurance Commissioners reported that in 2024, Minnesota property casualty carriers wrote over $18 billion of insurance. They had a combined loss ratio of about 59%, which I think is good. When you look at what we mandate for health carriers of an 80-20 loss ratio, of 59% loss ratio, I think is healthy. And let me just lastly address one thing, Mr. Chairman, and that is, will tort reform reduce costs? And of course, we would argue that that has never been the case. We've had reforms in Minnesota that have never once led to insurance premium reductions, unless it's mandated by statute, which we've done twice. We did it in 1974 when we passed no-fault auto, and we did it in 1996 when they had significant workers' compensation reform and the legislature mandated premium reduction. Those are the only times that has happened, Mr. Chair. But what do others say about tort reform and reduced costs? The American Insurance Association says the insurance industry never promised that tort reform would achieve specific premium savings. Probably the most active group in tort reform world, the American Tort Reform Association, their president, Tiger Joyce, says, we wouldn't tell you or anyone that the reason to pass tort reform would be to reduce insurance rates. And Victor Schwartz, their general counsel, has testified on tort reform more than anybody in the country, said that many tort reform advocates do not contend that restricting litigation will lower insurance rates. And I've never said that in 30 years. We're happy to look at real problems and real costs and how they can be reduced for consumers. We would suggest that when you look at the data, and we're happy to provide all of this is all publicly available to you, Mr. Chairman and members, we would suggest that tort reform and costs are just not going to save homeowner insurance premiums any money and possibly eliminate important legal rights. Thank you, Mr. Chairman and members. We appreciate the time you've given us, and we're happy to answer your questions.
Great. And Senator Seeberger, seated to my right, has been scribbling notes like crazy, so I know she wants to weigh in.
Thank you, Mr. Chair. I think thank you, Mr. Carlson, for your testimony and for your information. And I think it's important for members of this committee to realize and recognize that Mr. Carlson represents the Minnesota Association for Justice, which is made up of plaintiffs' lawyers, the ones on the billboards that you see along the freeways, the TSRs, the Schwabel, Getz, and Siebens, the Know Your Rights people, the ones that are drumming up the business for people to sue other people. And while there certainly are valid claims, for example, if I am driving and texting and cause an accident, I'm at fault. And if I hurt somebody, that person has a claim against me. There's no question about that. But we need to recognize the group of people that Mr. Carlson represents, and those people make money off of these claims. I joke a lot, but it's true. My good friend and colleague, Senator Nick Frentz, is a plaintiff's lawyer. He drives an Audi. I am a defense lawyer. I am the natural enemy of Nick Frentz. I drive a Mazda. This should tell you something about where this money goes. If I'm driving and texting and I cause an accident and the person I hurt sues me, I don't pay that judgment. My liability insurance pays that judgment. So I wanted to clear that up as well. Mr. Carlson spoke to the small percentage of claims, but these are still sizable burdens on insurance companies. And today I brought just a few printouts. I did my own research from my own practice of various claims that I defended. One was a construction defect claim that I defended a party on, and all I did was monitor the case. I didn't file any pleadings aside from a notice of appearance. I monitored the case, and over the course of a couple of years, I billed out $15,860 for doing nothing but monitoring the case. And this particular case had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38 parties. Nope, 39, 40, 41, 42, 43, 44, 45 parties. Construction defect case. So the plaintiffs were the homeowners, the defendants was everybody else. The window manufacturer, the installers, the carpenters, the trimmers, the roofers. These add up. In another construction defect case, I represented a general contractor and then no, I didn't. I represented the insurance company for the first general contractor and then the subsequent general contractor. They also had merits counsel. And I split my bills between them because the same insurance company, I was cutting them a break, so I was really working for half price. And on the first case, I billed $44,106, and on the second case, I billed $37,217. Add those together, that's my full boat rate. So while I was representing the insurance company as to their obligations to cover these particular contractors, the insurance company was also paying merits counsel to come in and defend. And what that means is merits counsel is, let's say I am ABC Construction Company and I get sued by the homeowner. I don't think there's coverage for the claims. The insurance company is obligated to provide a defense attorney to defend those claims. So Mr. Brickwitty now is defending ABC on the claims, and I'm over here being paid by the same insurance company to scrutinize the insurance policy and issue an opinion with regard to whether or not there's coverage. And we're all billing at the same rate. Meanwhile, experts are being hired, and a mediator is ultimately hired, and the mediators on these cases are making bank. My rate, when I retired at the end of next year, the most I ever made, the most an insurance company would ever pay me was $165 an hour. Mediators charge upward of $500 an hour. Plaintiffs' attorneys, when they are awarded attorney's fees, even though they're paid on a contingent fee basis, they get to create an hourly rate based on some lodestar formula. They typically claim fees of around $350 to $400 an hour. Meanwhile, I'm over here working for $165 an hour. This is where the money goes. And so one final thing. I also brought a personal injury example in. A case that involved a broken foot in a car accident. And I worked this case up until the point of trial when we ultimately settled it. I billed $47,476.21 for my work. That was just my work on this case. It didn't include the doctor that we had to hire. That cost around $7,000 when all was said and done for his examination and trial testimony. The vocational expert that we had to hire, the depositions, everything else. When we finally settled this case, we settled it for $850,000. Who paid that? The insurance company paid that. $850,000. Most plaintiffs' attorneys take a third. That plaintiff's attorney made $283,000 on this case. That's insurance company money that paid him. I made $47,476 at $165 an hour. So I think we need to keep in mind that the Minnesota Association of Justice represents the attorneys that are making $233,000 on a broken foot case. And that money is paid for by insurance companies. So even if these are a small percentage of overall claims, there are tremendous amounts of money that are being paid to the folks that make up the Minnesota Association of Justice, plaintiffs' attorneys, and their clients. So when you look at Nick Frentz driving an Audi and me driving a Mazda, ask yourself why that is. And ask yourself, where is the money going? And why would the Minnesota Association of Justice have an interest in coming to this committee and saying, it's not a problem, what we do? There's nothing to see here. I would beg to differ that there is a tremendous amount of insurance company money flowing to plaintiffs' attorneys in this state. That's what I think we have an obligation to look at. I'm not going to sit here and say we have to engage in tort reform. What I'm saying is we have to take a look at where this money is going. And this is certainly a factor. That's all I have to say, Mr. Chair. Thank you.
I knew you would have a fair amount to say, so thank you. And Mr. Carlson, you know I'm a complete data geek, so I'm expecting that you'll be able to provide some of these numbers to us.
Well,
Data.
Mr. Chairman and members, number one, I was very clear in my opening comment who I represented, consumers, policies, and their attorneys. But Senator, the case examples that you brought forward have nothing to do with the task force study in front of us. I am trying, our association is trying, not to say that these aren't important. It matters. My point is that if you're trying to reduce costs and you're looking at 2% of the insurance company losses, according to them, not us, that we're not going to make any headway for consumers. The construction defects claims, as I said in my comments, if you want to talk about those, let's have that conversation. That's not what this task force was charged with doing. And so I don't bring those up, and I don't bring up auto accident cases because that's not the focus of what this task force is. So we're happy to engage in that, and I think these are very important matters. But I can tell you that one of my great memories of listening to floor debates in the Senate is from Senator Scott Newman, a Republican lawyer from Wilmer, who said he never once saw a frivolous claim because the people that bring these claims don't have any incentive to bring a frivolous claim when there is not merit. And your insurance company wouldn't have settled that claim if it didn't have merit and that there was liability there. And that's why claims settle. And so I'm happy to stay focused and not engage in not from you, but from others, some of the rhetoric about tort reform and costs, and stay focused on what the charge of this task force is. which is, can tort reform reduce costs for homeowners? And to get to that, you have to look at how much of their homeowner premium is being paid for liability, costs, and claims. I don't know how we can avoid that.
Okay, thank you. Ms. Semfeld.
Mr. Chairman, thank you for your testimony today. Correct me if I'm wrong, but our task force is addressing a much broader spectrum than simply homeowners. We're also addressing master insurance policies for HOAs and commercial property. And we are seeing a much more significant impact in the liability area in those two sectors. And that was not, unless I'm mistaken, addressed in your statistics. They were personal injury only within homeowners.
Okay, thank you.
Mr. Chairman and members, the data is similar to commercial policies, and we're happy to provide that as well.
Cool, okay. Mr. Cocking, I think has a question.
Yeah, thanks, Mr. Chair. I appreciated Mr. Carlson's resuscitation of all of the other cost drivers that are leading to rising insurance rates. I feel like in all of the commerce committees that I'm presenting has been taking copious notes, and I appreciate that. I've got a lot of thoughts on this issue and will maybe hold, but the one thing I did wanted to point out to kind of piggyback on Senator Seeberger's comments is the fact that insurance money or these payouts is not coming from insurance companies per se. We have to remember that that insurance companies collect this in the form of premiums from policyholders. And so all of these claims and all of these monies that are going into these lawsuits are coming out of the pocket of policyholders through insurers. And I think that's a key distinction to make. And that's all I wanted to say at this point.
Okay, and then Mr. Kai, I'm going to take the opportunity to remind you that you're on the hook to help us recruit an insurance industry counterpoint for this, hopefully for our next meeting, so.
Done.
Yeah. Okay, questions from any other members? Otherwise, I'd like to move on to our next. We've got a couple of really good presentations yet on the agenda, so if we can move on, that would be great.
Can I have just one more question, Mr. Chair?
Sure. Mm-hmm.
I just wanted to clarify something that Mr. Carlson said. Mr. Carlson, could you just, you mentioned the combined ratio of, I think you said 59%. What year was that in reference to? That seems strikingly lower than anything I've seen. I just wanted to make sure I didn't mishear you.
Wait for the chair.
Mr. Chair, I'm sorry, Mr. Carlson.
Thank you, Mr. Chair, and thank you, Mr. Cocking, for the question. I have the NAIC 2024 market share report for property casualty groups and companies by state and countrywide. And according to the data for Minnesota, they wrote a little over 18, almost 19 billion of policies, and the combined ratio was the loss ratio was 59.04%.
Okay, thank you.
Thanks. The clarification on that being the loss ratio, not the combined ratio, was the distinction I was looking for, because that seemed incredibly low for a combined ratio. So thanks for that clarification, Mr. Carlson.
Okay, thank you. All right.
The loss and containment ratio was 66.59%.
Okay. And Mr. Brickwitty is nodding as well, so. Okay, cool. Thank you very much. Appreciate it.
Thank you.
Next testifier is online, is Galen Truer from Insurance for Good. And Mr. Truer has done a lot of consulting work in Florida, which is kind of like the worst case scenario for any state in the country. And I think he's going to have some good information to share from us from his experience working for governments in the Florida market. So Mr. Truer, are you there?
I'm here. Can you hear me?
Yep. Mm-hmm.
Great. And I do have a presentation that I can share, or I can send it later.
You should be able to share it, I think.
Okay. If you guys give me that privilege. Oh, here we go. Okay. 1 second. And thank you all, to the chair and to all of you, for having me. It is a privilege. And I am... 1 second. Can you see my screen here?
We can.
Excellent. Thank you so much. My name is Galen Schroyer. I am an independent economic development climate risk expert. I live in Duluth and moved there this last year. It's where I grew up. And I moved from Florida. I was working for Miami-Dade County most recently, leading climate and economic development. And that included some work on insurance and insurance innovation. So really, I'm coming here as a resident of Minnesota, very excited about what you all are doing and the fact that Minnesota is once again kind of leading and being on the leading edge. I am going to try and move through a couple of stories about Florida, drawing on my experience fairly quickly. And then I'm going to make 4 recommendations for the task force that are mostly related to affordability and climate resilience and a little bit to the liability issues. But those are linked directly to the themes that you all have identified. So working in Miami, doing this insurance innovation work, I was invited to become to join the community advisory board for Insurance for Good. This is a new nonprofit, and I think it's a really important resource for Minnesota, particularly to what we're trying to do here with making long-term solutions that work. It was founded by Carolyn Kuski in 2024, so it is just a year old. And it's really focused on creating the national community of practice that harnesses risk transfer for the common good. And they do that through a number of evolving activities, working with partners, private and public sector partners, and communities that share resources. They deliver capacity building within communities because a lot of communities don't have this knowledge, right? They don't have the ability to address these complex insurance issues. They also are an incubator for innovative risk transfer opportunities, and they work to improve policy and regulation in ways that actually work to increase the availability of risk transfer and make sure that people can continue to afford it. So I am going to just share some of my insights. This data is extremely important and it's limited nationally. And so the way that we talk about how much insurance costs and what is affordable is really complicated and difficult. I think one of the most interesting and useful pieces of information is from the New York Times. Chris Flavell accessed some payment data, a whole variety of data sets, and looked at the national scene. And this is an estimate from 2023, looking at how much premiums are. And you can see in parts of Minnesota, they are relatively high, and in South Florida, they're extremely high. But it's much more nuanced than that. If you look at the risk, you can see, oh yeah, Minnesota's got a lot of risk. It's not as red down there. If you see this, Florida's very red. Southern Minnesota, western Minnesota, it's more red, and a lot of that is the hail and the wind. But how much are we paying relative to home value is the real critical issue. If you look in Florida, home values have increased a lot, and that is a very important driver of insurance costs, along with replacement and risk. And I just I'm sharing this because I think we can sometimes get lost in the number of how much is my insurance and how much has it increased this last year. But we really, I think, need to look at affordability as what is the cost as a percentage of what you're paying to be housed, right? That's something that it took us a while, I think, in Florida to understand, but in my community in Miami-Dade, that is really important because then we can look at like, is this keeping people from being able to stay in their home, right? And is it making our community unaffordable as a place to live? And then part of what I want to do is remind us why we're doing this, why we have insurance. It's really about people and their lives. And we see this in Florida because homes are entirely destroyed. This is from Hurricane Ian. And you can see that those are people's homes and lives that are entirely gone. And insurance is really the way that they will rebuild. And if you have insurance or don't have insurance, really determines whether or not you get to stay in your community or not. And I just think that this is extremely important for us to remember, because insurance is incredibly important and incredibly powerful. And if people do not have the coverage, they are in a really, really tough place. And you can see from here, this is 2022, there were huge losses during Ian, and that led to reforms that were probably needed in the state to attract insurers, including tort reform. And that was really important because 2 years later, we had 2 hurricanes. And I'm sharing these pictures because it's important to understand how difficult it is for people, right? And this is preparation for Hurricane Helene after Milton came through and devastated communities. So one of the challenges here is, how do you actuarially decide which hurricane caused which damage? They were clearly not able to do those assessments all in time. And it is a very challenging experience. So part of what I've done with some of my work with Carolyn Kuski and Katie Maw was to think about where are we headed in Florida, right, with all of these damages that have happened. And just, I think maybe I'll go through this quickly and I'll share the report with you all. But we were trying to think about where could the state go. And there are 3 scenarios that we imagine. Scenario 1 is one where we have inequality and checkerboarding. And I think that that is what's happening. Certain communities are able to protect themselves. Certain homeowners are able to protect themselves and invest in resilience, and others can't. There is the possibility also for scenario 2, which would be that we transfer all the risk to the public sector, and the insurers are kind of pushed out because they can't afford to do their business. And ultimately, we think that that would lead to a catastrophic losses and drop in property values. The hopeful scenario, which is something that I'd like to encourage here in Minnesota, is adaptation and resilience, where we make concerted efforts to adapt our property so it's less vulnerable to the threats that we know are here and are coming, and then make sure that that happens across communities, because we don't want to leave out, in particular, the lower income, rural, smaller communities that might not have the capacity or the staff to ensure that they are enforcing the latest codes and providing the best support to their communities. Kind of to close out here, I wanted to share some experiences from Miami-Dade County. We were facing rising insurance costs, and our county doesn't regulate, so we wanted to address the issues in our community. And one of the things that we did was bring together 80 experts from around the country and around the world to talk to our community and in our community about what solutions exist and what the problems are. And we didn't just do panels and presentations. We got the group together and we talked for a day and a half in a really deep way. We got in the weeds and figured out what some of the barriers were and where some of the opportunities are. And I think that Minnesota has the opportunity to do something similar. Our takeaways from this is that we have to think long-term, but we have to act now. You need to get ahead of this. And that the housing and insurance crises are actually linked together. So don't try and deal with them separately. You have to do it together. Also, investing in risk reduction or resilience is actually the way that we act, because it reduces those future costs. And the there's a link between underwriting and risk reduction that isn't always made. This is the nuanced piece, but it's really important. And something that I think you all could look into more, but what is the link between underwriting and risk reduction? Finally, we also found that insurance agents are incredibly important, and that we, in Miami-Dade, they were our best communicators, right? They are incredibly important people in this mix, and they're really articulate and they know what's going on. So our communication needed to flow through them. And also state and local policy needs to coordinate and play with each other. If it doesn't, it won't work out well. I think before I get to these recommendations, I do want to make a point about how complex and challenging it is in Florida. The situation is not simple. One of the key things that's happened since reforms in 2022 is that there were 2 more hurricanes, and those hurricanes saw higher denial of claim, higher rates of denial of claim. It basically went up from about historically 30% to 35% and 45% for Helene and Milton. And that's a complicated reason. It's not just that the insurers are bad, but people were getting denied a lot because they weren't exceeding their deductible. And I think there are a lot of people who didn't realize how high their deductible was. And that is really painful, and that means that they likely would have to move, right? So I just wanted to share that piece, that the tort reform that happened brought new entrants into the market, and there is more coverage, but that coverage may not be covering what people expect. And there are still issues, and prices are still going up. Just one final anecdote. I've had multiple friends texting me after I moved to Minnesota, trying to understand what's going on when they're being depopulated from the Citizens Insurance Program, which is the state insurer of last resort. And essentially just walk them through what is happening, but it means that a insurer is providing similar coverage at 20% or less more. And they have a year to transfer, but it is alarming. It takes people time. It is really inconvenient in a lot of ways, because basically you just have an insurer coming and saying, hey, I got you. And you're taken away from the Citizens Program. Thank you all for listening. This is an incredibly important issue. And I think that in the short time that you have for your task force, I really would recommend that you follow these few thoughts. First, learn from Florida, but don't copy the mistakes. Like, really dig into what's going on there. I'm happy to provide additional materials, and also there is a lot of study of what has happened there. And that really means collecting data and being aware of what has happened in Florida after tort reform. I'm not an expert on the legal pieces of it, but I do understand that it changed underwriting and encouraged new entrants, which is great and gives you breathing room. But it also has transferred some of this regulatory burden back to the state. And it is the regulations for insurers in Florida are much higher, even though they're getting more non-admitted carriers, particularly for the multifamily housing sector, that those costs are going up, and the regulation is going to have to come. It always goes back to the state if people are not happy with their insurance. So for number 2, pursue risk reduction. We can talk more about this, but I think I've heard a lot from everyone. It's really important that the risk reduction happens, right? If you do not reduce the risk to the rising climate impacts, then insurance is just going to have to go up. It'll cost more. And you can do that through targeted support with communities, endorsements, which or other ways of reducing that risk when you rebuild, and then through innovation. Number 3, I would encourage you to engage with insurance agents and brokers. There are a few brokers like Marsh McLennan and Howden that are working very hard on climate and have hired experts, and I would encourage you to engage with them. And then finally, we haven't talked a lot about flood insurance because it is dealt with separately, but I would encourage you to find time to either talk about flood insurance or make recommendations for a future look specifically at flood insurance, because we are seeing actually a natural experiment happen right now where, with the federal government shutdown, the National Flood Insurance Program is paused in writing new policies, and the private sector is stepping in, but it is an imperfect solution. And it will be challenging for folks who are looking for insurance right now who are buying in a flood zone. And I think that if you ignore that piece, you'll have to come back and talk about insurance again, because people are going to be raising those questions. Thank you very much. And if you have any questions, I'm happy to answer them.
Thank you, Mr. Troy. And can you provide a copy of your presentation and that report to Mr. Turman so we can include them in the materials as well?
I absolutely will.
Okay, thank you. Members, questions? There are no questions right now. We'll keep on moving. I'm sorry? Oh, Aaron, did you have a question?
Yeah, just real quickly, thank you, Mr. Truro, for your presentation. I was wondering, just from your experience in Florida, if you can talk about what the cost of insurance and the market signals that it sends about someone's risk is, and how Florida kind of dealt with that, and the importance of us looking at that in Minnesota. And maybe that's too much, but I feel like that's an important conversation about the value that insurance plays in the market, is sending risk signals about what someone's risk is.
Yes, thank you, Aaron. It's complicated, and I think this is something that I would recommend you dive into this deep. Maybe there are a few of you that could do that, because it's not straightforward. And that's what we found in Miami-Dade, right? Like you can have a good functioning roof, and if that roof isn't given credit by the insurance company, which oftentimes they use simple formulas then that are not specific to your property, then you don't get credit for it on your premium. And they're working on making it better, but that is a slow process. I think maybe I'll just add one other thing. I have talked with an insurance agent in Minnesota who their firm does about $50 million a year in premiums. So they're, sizable. And he said that he really anticipated the lockup of the market that's happened in the rising costs. And he's also anticipating that there are going to be new entrants coming in. So we may get a reprieve in the next couple of years if there aren't huge losses right now, because he's having insurance companies curious and interested, right? So I think that to think about these timings, like how new market entrants may be coming, is something that, Aaron, you could talk more to. But these new entrants may bring new technology that can assess the actual risk of a roof, as opposed to some formula like the roof, it has these types of shingles and is 10 years old or 25 years old.
Thank you.
Okay. All right, thank you. Okay, if there are no further questions, we'll move on to the next testifier. Kristen Incity. From Habitat for Humanity for Minnesota. Welcome.
Hello, everyone. Thank you, Chair Elkins and members of the task force. My name is Kristen City. I'm the CEO of Habitat for Humanity of Minnesota. And I have some remarks noted, but several of my previous testifiers hit a few of those points, so I don't want to repeat those things. But I want to start by saying Habitat Minnesota is a state support organization for 24 Habitat affiliates that serve the state of Minnesota. So when you think of Habitat for Humanity, they're the ones that are doing the building in their local communities. They're recruiting volunteers and creating affordable homeownership opportunities across the state. They serve about 59 counties. One of the largest Habitat affiliates in the country is based here in Twin Cities. And then we have 23 other affiliates that range in size from about a part-time executive director to 10 or 15 staff. And I'm sharing all this because I think it's important in the context of this conversation. Additionally, a lot of people don't know that Habitat for Humanity affiliates are both builders and mortgage lenders. So when we're talking about this insurance situation, we're talking about both sides of what's been sort of discussed today, from the real estate side as well as the lender side. Habitat for Humanity affiliates historically would sell the home to families with a 0% interest mortgage and then portfolio those loans over 20 or 30 years, depending on the affordability for that family. So when we're thinking about risk in our portfolio, we're both thinking about family stability and household stability, as well as the mortgage portfolio with the Habitat affiliate across the state, right? Some of the things I wanted to talk about here is Habitat for Humanity. We serve low and moderate income households. We're reaching households at 80% and below area median income, typically even lower than that. Many households are at 50% area median income and below. We're one of the only affordable homeownership providers doing that level. Us and Community Land Trust providers, I would say, would be the ones who are really focused in that range. And our main kind of thing that we want to communicate is the rising cost of homeowners insurance is disrupting homeownership stability. And the earlier testifier from PRG and the Homeownership Center kind of hit on this. But what we're seeing is a few things. So one, we are seeing that households are seeing their homeowners insurance just be revoked without any cause or any claim. They're being dropped out in greater Minnesota, and then they have a really difficult time finding new insurance. So Chair Elkins, you were asking about that earlier today, that in the event those households couldn't then find their own provider, then the Habitat affiliate would be responsible for finding that forced place insurance that you were asking about earlier. So a couple of things that I wanted to note, we sell the homes, and so part of that, just like the Mortgage Association testifier we're talking about, we're looking at the insurance upfront as well in the underwriting process. And the Habitat affiliates are finding that their families are having a difficult time finding affordable products for their homeowners insurance. So just in the long-term housing stability space, and a couple of examples, the Twin Cities affiliate, which is based here in the 7-county metro, is seeing an uptick in homeowners who are wishing to sell their homes, citing that the increase in taxes and insurance is what's making their homes unaffordable to them. They found that owners might even proceed with a loan modification, so Twin Cities has worked with them to make their first mortgage affordable. And in order to reduce their principal and interest payments, and the cost of insurance and taxes is still leading to a sale back to the Habitat affiliate. We've also heard today about homeowners associations. Habitat affiliates do build homes in homeowners associations, and we know for sure this is impacting Habitat homes here in the Twin Cities. The Twin Cities affiliate has heard from homeowners who live in homeowners associations that the master provider of the homeowners association has dropped the coverage or moved out of the state, and that HOA is having a difficult time finding providers to provide provide those master policies. And the older communities in particular, like the age of the stock, not the people who live there, just to clarify, are having a really difficult time finding insurance. So that's Twin Cities. I would say this is also impacting greater Minnesota. The Lakes Area Habitat for Humanity, which is based in Brainerd, but serves Crow Wing, Wadena, Cass, and Hubbard counties, has seen how this is impacting families in their community, and they shared that renewal statements for homeowner premiums no longer surprise them. In the last 12 to 24 months, premiums have consistently doubled and in some cases tripled. Renewal premiums on a simple Habitat home are now commonly in the $1,400 to $2,800 range, with deductibles anywhere from $1,000 to $5,000. Now, for some of us, that might seem manageable, but for low-income households, those premiums and deductibles are no longer affordable. I don't know what the average savings amount is for the average household in Minnesota, but I'm sure it's less than $5,000 in the low-income community. So if we suffer a natural disaster, that deductible is really disruptive and causes housing instability. And just to note, that's not anecdotal. I think you have a copy of this report, but the Minneapolis Federal Reserve's article from last year titled Homeowners Insurance Costs Are Growing Fast, but Coverage is Shrinking, is confirming that states like Minnesota experiencing strong winds, hail, and wildfires are amongst the Midwest states that have seen the sharpest increases in homeowners insurance costs. So what we care a lot about is not just families entering homeownership, but sustaining it for the long run. We're really focused on trying to break the cycle of generational poverty through our nation's greatest wealth building tool in affordable homeownership. So we want families to be able to sustain that long into the future and pass that home on to future generations. So a solution that we are working on and advancing is we were really excited about the passing of the Strengthen Minnesota Homes program. While the program itself has yet to get up and running and provide grant funds, we are already seeing how this could work with habitats across the state and have been also monitoring our peer organization, Habitat Alabama, has been working with the Alabama program as well, so we're monitoring that. Habitat for Humanity serving Winona County is one of the first developers in the state of Minnesota to build using fortified roofs. To date, they've installed 5 fortified roofs, and the home they're working on now will be the 6th, and 2 of them are IBHS certified to date. So far, the projects include 1 single-family home and 2 duplexes. The current build in progress is a single family. And at this time, we're not aware of any homeowners receiving an insurance discount, but we think that could be due to administrative and other paperwork hurdles. So as the committee is thinking about solutions, the paperwork and the administrative process is something that I think could be really helpful to explore and understand more deeply. And so, as you explore this work, we think there are at least 2 things the state could do to advance the roofs, launching the statewide grant program and ensuring the resources are available for low and moderate income households. The program would support the goal of making it financially viable for these households to have these types of roofs installed in their homes and support long-term affordability. The Alabama program, I talked with them earlier this morning, they set aside a pool of resources for that Habitat partnership, and it's helped them achieve about 25 to 28% of their installs have reached low and moderate income households. So as you're thinking about a promising practice to do that, that model could be something that could be easily replicated here in Minnesota. And then investing in and incentivizing more trainers into Minnesota to advance the work. So Minnesota needs more certified trainers and more roofing contractors who are certified in the fortified method itself. And having a larger workforce doing the work will help ensure a statewide impact. So that way we know that folks across the state can have access. So the style of roofing installation helps prevent structural damage during a windstorm and would support the goal of keeping a home affordable and safe for the long term. And as I've already said, we really are focused on that long-term stability, and it means building homes that are efficient, resilient, and often go above code requirements. And I think our last testifier was sort of getting at climate resilience and what can we do as a state to invest in that. Just a quick stat from Alabama's program that I was able to gain this morning. They've invested about $95 million into their program, and they've served about 9,500 households all across the state of Alabama. They credit the intentional partnership with Habitat for Humanity and a set aside of those resources to helping them achieve the outcome of reaching those households in underserved communities, because it allows for the Habitat affiliates in that case, here in Minnesota, you could expand it to nonprofit developers or something like that. But it allows for the patience of the time it takes to build in the nonprofit affordable homeownership space in comparison to the for-profit market, to have that set aside just from a competition perspective. So they were able to credit that. So based on, all of this, I'm really grateful that you're working on this. We think this is a really valuable effort, so thank you so much for the time and opportunity to share our experience, and I'm happy to take any questions.
Yeah, thank you. And members, pointed for the next meeting on November 12th, I think we've got testifiers lined up from IBHA and someone from Alabama who was involved in that program. So this is, I think, going to be one of our major themes.
Wonderful.
Cool. Thank you. Questions? Ms. Johnson? Okay. Yeah.
Thank you. Thank you for your testimony, Kristen. I am curious, because you do provide mortgage products as well. When the mortgage bankers testifier was talking about making adjustments to required coverage, is that something that you already do? Is that something that you're thinking about doing as well? Especially given that I'm guessing it sounds like a lot of homeowners are not taking claims, but I get that it's a weird position because you're the insurer last resort, so, yeah.
Mr. Rickwitty?
Mr. Chair, I just wanted to say just a note of thanks on 2 points. Habitat for Humanity has been a tremendous partner for the department, ranging from helping to be at our State Fair booth in the Eco Experience building, talking to Minnesotans there, hosting Commissioner Arnold and her counterpart from Wisconsin at one of the properties. It was really exciting to see it in person as it was getting framed up, and then also to see the pictures from the ribbon cutting earlier this year. And I just, maybe a note for us to think about and maybe return to from the previous testifier in Mr. Cocking's question to Mr. Troyer. This is a great example of a builder who can build and reduce risk. Mm-hmm. And I would posit for us to be thinking about, this is an illustration, I think, of what Mr. Troyer was talking about in real time. It's a property that the price of the risk is lower. Those Habitat homes are materially better risks than the buildings that might be right next door to them. And we should be pricing them accordingly.
And Mr. Reams, did you have a question? No, okay. Ms. Johnson?
I had a question, so I just wanted to give Kristen
Chair Elkins, members of the committee, thank you, Ms. Johnson, for your question. To summarize your question, you're asking if Habitat is thinking about how we prepare families in their purchase of homeowners insurance and what they might be looking at in their policies to set them up for success. It is a delicate dance, trying to make sure their policies are affordable to set them up for success, but also to mitigate their own financial risk. We have been talking about replacement costs that came up earlier, I think, versus what it might be worth today. What might it actually cost them to replace their home, should they have? So I would say right now we're in the education and inform stage, and over time I think we'll have to become more sophisticated in navigating both client advocate and portfolio protection.
Great, thank you. Okay, then, thank you very much. Appreciate your good testimony. So to bring it home now, we have Gary Rupp, who runs the Minnesota Fair Plan, who's going to give us an overview. This is another topic that members earlier indicated that we needed to learn more about. So we've been looking forward to this.
Great, thank you, Chairman. My name is Gary Rupp. I'm the Executive Director of the Minnesota Fair Plan. I've worked there for just over 27 years now. So I've seen a lot of things, and I could talk forever about the Fair Plan. I love it there, and I think we do a lot of good things. So just to start with, I'll give you and I don't know how much people know about the Fair Plan. I'll give people a little overview of what we are and what we do. The FAIR Plan was started through an act of legislature back in 1969, and that came across due to the riots back from the 1960s. And FAIR actually stands for the Fair Access to Insurance Requirements. So we've been around for quite a while. Nationally, there's 38 FAIR plans, 7 wind and beach plans, which are similar, and some other plans that address it as well. And they vary in size, like, Florida, California, they're huge plans. Here in Minnesota, we're fairly small. Our governing board is made up of 9 members, 5 of which are elected by the insurance industry, and 4 of which are appointed by the Commerce Commissioner. Currently, the current board members from the companies are State Farm, American Family, Western National Farmers, and North Star Mutual. And where we get our funding is our funding comes primarily from the premiums that we charge, but we also have the ability to assess. So if we run out of money, what we do is we assess the industry based on their percent of market share. So if we needed $2 million, we'd assess the industry, and State Farm would pay us approximately 20% of that based on the size of what they write in the state. And fortunately, we haven't had to have an assessment since 2002, so we've went quite a while without having to assess the industry. We offer a variety of policies. We offer our homeowners program. We offer an HO8 policy, an HO6 unit owners policy for town homeowners, and we also offer a renters policy. Although our policies are HO8s. We just have a few unit owners, although, town homeowners. They're getting to be more of those. We have, probably a handful of renters, because usually the renter's insurance is pretty available to most people. As being the FAIR Plan, to qualify for coverage with the FAIR Plan, you have to be unable to get insurance through the standard market, either canceled for whatever reason, non-renewed. And typically what we see as far as the factors that cause people to come to the FAIR Plan, lots of times are the number of claims that they've had, also the condition of the property. I think we've heard some people talk about, roof conditions and things like that. So we get a lot of people coming to us because of the condition of their property. And the third would be location, in the sense that they don't have fire service. If you have a cabin on an island, or, somewhere that the fire department can't service, lots of times insurance companies don't want to take those, just because, if a fire starts, there's no stopping it. So those are our primary reasons that people come to us. We're not, the one thing we're there for unavailable, if coverage is unavailable. We're not there if coverage is unaffordable. So if you can find coverage, even if it's not the price that you want, that you're required to take that coverage and not come to the FAIR Plan. And also, we don't employ any agents of our own. Every agent within the state of Minnesota is able to place insurance with the FAIR Plan. And as a matter of fact, they're required to do so. They can't, if the insured comes in and they can't find coverage for them anywhere, they're required to submit an application to us and not just turn them away. Although that isn't always the case. Sometimes the agents do turn them away to go to another agent. And we don't take everything that comes in the door. We're, through statute, we're allowed to apply reasonable underwriting guidelines as well as what comes to us. And typically what we'd be looking for, our homeowners policies are the only ones that provide liability insurance. I probably should have mentioned, we do write, in addition to the homeowners, we write dwelling fire, and we also write commercial, and we write farm fire as well. So we do have a broad range of policies. But typically what are going to disqualifying factors to come to the FAIR Plan is going to be the condition of the home. If the home is open to the elements, there's holes in the roofs, missing windows, things like that, we're not going to take the property. If it's been condemned and not habitable, we won't take that property as well. We will take vacant properties, but the vacant property there's a couple qualifying factors for that. It must be in the process of being repaired or upgraded, remodeled. Or it could be for sale, or it could be part of an estate. So if it's just a vacant property sitting there unused, we're not going to take that either. We don't take properties that have delinquent property taxes either. It's kind of one of the other disqualifying factors. And the other is it's too large. We're a relatively small organization. Our limit of coverage that we've had in the past was tied to the statute for the surplus lines minimum, which last year was 1.9 million. But that was just recently changed because the statute was lowered. So it's lowered to 500,000. Although we're continuing to write to the 1.9 million, we don't get many that large. Until we have our new guidelines, we submitted those to the commissioner for approval, and we've proposed some new limits in there that would be set rather than tied to something else outside our purview. I guess as far as the number of policies we currently have about 3,300 policies, roughly kind of a breakdown on those. 36% of those are homeowners, 54% are dwelling fire, 8% are farm fire, and 2% commercial. Our written premium last year was about 4.5 million. And that kind of breaks down similar as well. Our homeowners accounted for 46% of the premium, dwelling fire 42%, farm fire 8%, and commercial 4%. And I guess kind of one of the things we're looking at is the trends, unavailable in insurance. In our new applications over the last 5 years have increased quite a bit. In 2021, we had 818 new business policies. 2022, we had 709. 2023, we had 834. 2024, we had 1,046. And through September of this year, we have 740 new applications. So we have seen some growth, although our numbers, I think our policy numbers in force haven't increased as much as you would expect. So I think we are working pretty much as expected, where they're coming for a few months, getting coverage with us, and then hopefully finding coverage somewhere else. As far as rates, like all other companies, we've taken some rate increases lately. We made the intentional decision not to increase rates during the COVID. So we didn't, 2016 was our last rate increase until we increased them in 2023. We increased our homeowners 18% and our dwelling fire 14.5% in 2023. And then in 2024, we increased our homeowners an additional 14.9%. And our dwelling fire 8.5%. And typically what we've done, and this is, our rates are always approved by the department before we can put them in place. And we try to stay at the market or a little bit above, because we don't want, we're there for people that can't get insurance anywhere else. We're not there as an affordability issue. So I guess that's kind of an overview of what we do. And, I'll take any questions and kind of how we operate and kind of how we fit in this whole thing. And I would just a couple comments on some of the other testimony that I heard. I guess in answers to Peter's question on do mortgage companies accept the fair plan coverage? Yes, they do. Even though our dwelling fire policies, our homeowners policies are repair cost, our dwelling fire, commercial, and farm policies are all ACV. And the mortgage companies do accept those. We might wrestle a little bit over the coverage amount. But they'll accept those as legitimate coverage for the mortgages that the people have. And then also, the last speaker was talking about the fortified homes. I think that's a great program as well. I've been out to IBIS and seen some of the things that they do and the testing they do. And I know Alabama has a program, and actually the North Carolina Fair Plan, which is much larger than us, has their own program where they do grants to fortify homes along the coast. And they've had some good success with that. We don't, we've got, I guess as far as our assets that we have about, we have about $4 million of assets is, what we have. And we were we said we were down a few years ago as we talked. I think, there's some talk about, 2023 being a bad year and 2024 being a good year. But if you go back to 2019, 2020, 2021, 2022, those are all bad years too for us, and as well as the industry. I think the industry, the article that I read recently, and I don't remember where it was from, was that Minnesota was the only state in the country that had 5 years in a row where the residential homeowners industry lost money. So it was a lot of bad years in a row. And thank God 2024 and 2025 have been good years for us. We probably, I think at the end of 2023, I was pretty sure we were going to do an assessment. But we knew we had the rate increase had just been approved, so we wrote it out. Unfortunately, since then, the claims have been down and we've been able to get our footing. But it's been good. But I think the Fortified Home Program is a really good program to look at in the state. And I think there's a lot of things we can be done in that area. And the other, I guess maybe the other comment I would have, there was a comment about the depopulation program in Florida. And I think that's been a big thing for them over the years with the FAIR Plan, well, actually Citizens, Citizens in Florida is a combination of the Florida FAIR Plan and the Wind and Beach Pool went together years ago and formed Citizens. But they've had this depopulation program for a long time, and that gets back to the point where the FAIR plans are there for unavailability, not affordability. So if they can find coverage, similar coverage, at a similar affordable price, that's why the Florida FAIR Plan, I'm assuming, is moving them out. And we don't have anything like that in here in Minnesota because we don't have the issues with the kind of coverage that they do. I don't know if there's any questions or.
I see Mr. Brickwood, he wants to make a comment or a question.
Mr. Chair, I've got 3 questions. Mr. Rupp, can you tell us a little bit more about the nature of the commercial policies that the FAIR Plan offers? We've heard testifiers today and in previous meetings about homeowners associations having trouble sourcing their master contracts. Is that something that an association could come to the FAIR Plan for?
No, we just don't have the capacity for that. Like I said, we have, our limit currently for commercial is 1.5 million. And I mean, we have $4 million in the bank, so we couldn't, the association coverage would be well beyond what we could handle capacity-wise. We just don't have the money for that type of coverage. And our commercial business, I mean, I believe we currently have 57 commercial policies, and they run a variety of different things. We actually have a tire recycling plant and some other things, but most of our commercial policies are, apartment building, smaller apartment buildings and those type of things is kind of where we rely on that.
Mr. Chair and Mr. Rupp, you also, thanks for the breakdown, both of the percentage of policies in different markets and the premium as well. Does statute require the FAIR Plan to offer a certain kind of homeowners insurance product? Like I think I heard you mention that most of the homeowners insurance is on an HO8, and maybe you could say what an HO8 is relative to the other plans.
See, what was the last part of the question?
I guess my question ultimately is, does statute require the FAIR Plan to offer an HO8 as opposed to a different kind of homeowners insurance policy that's more comprehensive?
I think the statute doesn't require us to offer any particular policies. I think I don't know if the statute or the plan of operation used to require us to use ISO policies was the only requirement there was. And I think that was removed a few years ago, maybe to give us more flexibility. But there is no requirement as far as us offering homeowners insurance. And I think I mentioned before, there's like 38 FAIR plans across the country. I believe at my last count, there was 16, or there might be 17 now plans that offered homeowners. The rest are just offering dwelling fire coverage. And maybe just to go back on your question on the associations a little bit, there are some plans that are Colorado FAIR Plan is they started I think they sold their first policy in May, so they're brand new, but I think they're doing some different things on the commercial end of things where they're offering like up to $5 million in coverage on some larger commercial, kind of the first layer of coverage on larger commercial, but then I believe they may have assessed for like $50 million as well. So they're taking a different approach to some of that stuff that we just don't have the capacity for.
And Mr. Chairman, Mr. Rupp, could you talk a little bit, and this is a good segue, could you talk a little bit about the FAIR Plan's capital stack and how you would go about paying claims? You mentioned, and this is a very good thing for Minnesotans, that you haven't had an assessment in many years. It's good because assessments are passed on to the industry and also then passed on to policyholders. But can you talk a little bit about how the sort of financial organization works within the FAIR Plan for how you pay claims to avoid getting to an assessment? And is there any reinsurance or other types of capacity before you would get to an assessment?
And this is something that we looked at pretty deeply a couple of years ago. Like I mentioned, at the end of 2023, we were in a kind of precarious position at the time because we had like $2 million in the bank, and we had risks that were $1.5 million. So if that building burned up, then we'd be out of money. And so we were looking at the assessment, and we ended up not having to do it. But we also were looking at reinsurance as an option. And when we first looked at it a few years ago, we were told absolutely not. The reinsurance market was in disarray at that time. But more recently, we've had some discussions with Guy Carpenter and they're doing some innovative things with some of the other FAIR plans particularly on commercial. What we're looking at, I mean, we looked at like the, for the convective storm reinsurance, and just for a plan this small, as the size of us, it didn't make a lot of sense, but we're working more at like a facultative reinsurance, just for reinsuring the larger commercial risk. Like if we have a commercial policy come in at 1.5 million, where maybe we'd retain 500,000 of that and then give the rest of that off to the reinsurer. And they've set up a program, I think Guy Carpenter has a program like that with Missouri Fair Plan currently. And we've been looking at with them as well. Actually, it reminds me, I got to follow up with them because I'm waiting to hear back. So we're looking at that as an option too. We'll probably be discussing that in our next board meeting in December to some extent, hopefully, if we have more information.
Mr. Chairman, I'll just close. Thank you, Mr. Rupp. Really wonderful information. You're a paragon of transparency. I think every insurance company should just say out loud to the legislature how much money they have in the bank. I think the point that I'm driving at with that question is that if the task force were to examine recommendations for expanding or studying expanding FAIR Plan options, that this is something that we would have to really dig into with you as well, because the ability of the FAIR Plan to pay those claims without going to an assessment is a really important part of how other larger FAIR plans that cover more commercial risks, or for that matter, more homeowners risks, how they're able to accomplish that without those costs coming back towards the rest of the market. And I think, Mr. Chairman, that's something that we would really need to think about. And I think great to hear that you're talking with some of the leaders in the industry about some of the innovation and ways that we might be able to work with an entity like the FAIR Plan to provide that. Because as Mr. Rupp, I'm so glad that you answered my question that I posed earlier in the task force hearing. That's one of your best advantages for consumers, the ability for a FAIR Plan product to be accepted by Fannie and Freddie in a transaction is an advantage for you relative to places where in other market type products products from other markets that we've heard homeowners and commercial market shoppers have had to turn to. So I think things perhaps, Mr. Chairman, for us to continue to think about diving into more deeply.
No, I agree. I suspect, Mr. Rupp, that when we get to the point where we're rolling up our sleeves and considering alternatives, that we'll have you back.
Yeah, well, I was going to offer to say I'm willing to come back anytime. And like I said, I'm always willing to talk about the FAIR Plan. And I love what we do there, and I think we provide a good service. I think we maybe need to do a little better job after listening to some of these people of letting people know we're there. The agents all know about us, but it sounds like maybe we need to do a better job with some of the other groups to let them know, hey, we are here for people that are having trouble with insurance.
Yeah, but you have a basic infrastructure that we can build on.
Yep.
Yeah. Okay. Yes. Jean?
Thank you, Mr. Chairman. Thank you so much, Mr. Rupp. It's very informative. Let me just preface for those who might not have been familiar on the discussion with it, just at a low level, that facultative is reinsurance for a specific risk as opposed to treaty that is reinsurance for a large group. And it's obviously more complicated than that, but just so they have some background on that piece. I also wanted to thank you for the comment regarding looking at a longer time period, and that's really valuable, whether it's the FAIR Plan or the traditional marketplace. We've looked at 10-year data for the state of Minnesota for homeowners, and over the last 10 years, it's lost money in that sector. So we really can't look at 2 or 3 years and assess how the industry is performing from a combined perspective. Thank you.
Yeah, thank you. Any other questions for Mr. Rupp right now? Because we're about at time. If there are before we adjourn, if there are anyone that on the group that would like to have anything they really need to say, basically the next meeting is November 12th. We've talked about it. It'll be like this one. We'll be drinking from the fire hose again. And Mr. Chairman is going to send out a list of who we've got committed to speak, who we're going after. Look at that list. If you see gaps, let he and I know as quickly as possible so that we can go back out in recruiting. But this has been very worthwhile today, and I think the one next time will be equally worthwhile. Senator Seeberger. Yeah.
Thank you, Mr. Chair. This has been a really good meeting and a lot of really, really good information. I simply wanted to clarify on some of the statements I made earlier. I used Senator Frentz as a comparison, and I did that because we park next to each other in the Senate garage. And we have a good-natured joking relationship back and forth, and I sort of exposed our joke to the public light of day, and in no way was I trying to impugn my friend and colleague, either professionally or as a legislator. He remains a valued friend of mine. I have never gone against him professionally, lawyer to lawyer. I respect what he does as a profession. I consider him a mentor here in the Senate, and certainly hold him in the highest regard, both as a plaintiff's lawyer and as a legislator. I just wanted to make that clear. He's my friend, and to the extent that anything I said in the heat of my passionate response regarding litigation costs here in the state of Minnesota, nothing should be assumed to be in any way hostile toward my good friend, Senator Frentz, or in disrespect to him in any way. So love him to death. He's my pal. Thanks.
So would you think he was watching? Probably not. Okay. If there's no other business that needs to come for us, then we can be adjourned, and we'll see you back here on November 12th.